Right. Yeah. Hello and welcome, everyone. We're also glad that you could join us today for our Market Outlook webinar. I'm Michael Matheson, and with me, Scott Robichaud, Susan Anderson, and Marie Henricks is somewhere out there as well. Whether you're tuning in to us over an early lunch or a late breakfast, between errands, or just here for economic entertainment, we appreciate your time today and joining us. Today, we're going to walk through what's happening in the markets, what it may mean for investors like you, and how we're helping our clients stay focused in the midst of all the noise. Our goal is very simple: to keep you informed, grounded, and confident in your plan. So let's dive in. And don't worry, we'll try to keep the charts exciting and the jargon to a minimum as we move forward. So let's talk about the economy. This is always the topic that everybody's asking us about, and we're constantly learning and trying to understand. I'm going to let Susan kick us off and chat a little bit about what's going on out there. Susan?
Yeah, thanks, Mike. We're halfway through the year here, and the economy is sending us mixed signals. The first quarter was volatile, especially in March when businesses rushed orders overseas ahead of the new tariffs. And this made the data look choppier than usual. So what I'm showing you here is growth, the economic growth alongside data from the Institute for Supply Management. ISM. The ISM tracks business sentiment, and this is a key measure that has been trending lower, thus pointing to a slowdown from rapid growth we saw after the pandemic. And while GDP rebounded after an early dip, we believe this recovery may be short-lived. Ongoing changes in trade policy, uncertainty over debt, the new legislation all make it difficult to tell whether the economy is truly gaining momentum or just experiencing temporary swings. However, we continue to highlight that a resilient economy should provide a nice buffer from geopolitical shocks. But let's go to the next slide. And really the key takeaway is that growth is slowing down and the speed of the slowdown is yet to be determined. So now on the next slide here, we're looking at the inflation numbers alongside Fed funds upper bound target. The shaded area on the far right shows the forecast for the rest of the year. Supply constraints have been driven by shifting trade policy, geopolitical tensions, and ongoing supply chain disruptions. Because of this, we are likely to keep inflation above Fed's 2% target. And the restructuring supply chain raises production and distribution costs, leading to delays and higher consumer prices. Thus, as indicated, our economic growth is slowing, but the pace is uncertain. With tariff uncertainty, has likely delayed rate cuts that might otherwise have happened. We expect inflation to tick up modestly in the near term, but remain stable with mid to high 2% range. That's above target, but not accelerating sharply. If growth slows more expected, we think the Fed will respond with modest rate cuts to support the economy while keeping rates above inflation. So I think on this next slide, gives you another variable that's not really talked about too much, but it's really, really important to think about. And that as it relates to not just demand for labor, but the supply of labor. So what we're looking at here comes from the Bureau of Labor Statistics, and they're the ones that give us that monthly non-farm payroll numbers, but they also do the jobs opening and labor turnover survey, which is JOLTS, JOLTS. And what this includes is the quits rate and the hires rate. So the quits rate is showing workers' willingness to leave a job for another. The hires rate measures business demand for labor. And together, these provide a clearer view of the balance between labor supply and demand. Near term, the labor market appears stable, but we see choppy waters ahead. As the labor force is slowing, and while companies may be more cautious about adding staff, they're also hesitant to cut workers after recent hiring challenges, which, essentially stem from COVID. And this often means reducing hours for their current employees before cutting payrolls, keeping our unemployment numbers lower than in a typical cyclical slowdown. And really, the bottom line, businesses will likely become more reluctant to add headcount, but hesitant to cut headcount. At least not at the same magnitude like a normal cyclical slowdown. And now on to the next. This will be my last point on the economy before handing it back to Mike. What we're looking at here is the ongoing uncertainty around U.S. trade policy and tariffs, a major factor that has been shaping business decisions in the months ahead. Volatile and unpredictable tariff changes have become a significant obstacle to strategic planning and investment, which is discouraging companies from committing capital to expansion in infrastructure or international markets. Since shifting rates can quickly erode profit margins, this is what is happening. But as long as businesses are able to find free trade zones, exclusions, and other loopholes to defer or minimize tariff rates, we don't see trade policy as a factor in raising recession odds. And really, the impact depends heavily on where the average effective tariff rate lands. If it stays in the mid to upper teens, it's a headwind to growth, but not necessarily a recession trigger. Earlier this year, we saw our concerns rose when rates looked ahead toward the mid to upper 20s. That's a level that at that level could have been more serious consequences. Still, this unpredictability adds financial risk and forces businesses to be more cautious. That caution can slow near-term growth and prolong a softer economic pace through the second half of the year, even if recession fears remain contained. And I think this kind of sets the stage up nicely for Mike to talk about stocks next.
And the topic that everybody's asking and wondering about, of course, is direction with what's been happening in the markets in the world. What direction are we going? To help us with the difficult task of gauging where the markets may go over the next 6 months, we turn to history as a guide. We examine how the S&P 500 fared after the last 15 corrections since 1950, which corrections are defined as declines of 15% or more. The most recent correction this year began on February 19th and hit the 15% drawdown mark on April 4th. The first takeaway is results are really all over the map as to what's coming up next, meaning this new bull market could easily break higher or lower. The second takeaway based on history is to flag that the best stock market performance after corrections tend to come when the economy is emerging from recession or coming out of a crisis. And while we don't know if corrections will turn into bear markets, which are defined as 20% declines or more, and past performance does not guarantee future results, if they don't, stocks are very likely to be higher over the next 6 to 9 months based on history. So turning again to history, the unusually sharp and fast V-shaped recovery we had from April 8th of this year through mid-May had very few rivals. However, the S&P 500 has rallied 15% or more in 28 trading days or less, 11 other times since 1950, as it did from April 8th through mid-May. Subsequent 12-month returns for the index after these occurrences averaged 26%, with all 11 periods producing positive returns. Before you expect that much upside, consider most of these periods again immediately followed recessions or significant growth scares, really hardly the environment we're in today. Corrections, 10 to 20% declines that were fully recovered may be a better way to assess current market conditions given a new high for the S&P 500 following its April through May correction has been reached. I mean, we're seeing new records as we speak. So once a correction loss is fully recovered, double-digit gains over the next 6 months are reasonable expectations, though again, past performance does not guarantee future results. So here's a big one. I mean, we're all talking big tech constantly. Big tech continues to provide significant earnings boosts. If stocks are going to be meaningfully higher from here through the end of the year, earnings will be an important part of the story, of course. And you can't talk about earnings without the two T's, tariffs and technology. So as Susan mentioned, starting with tariffs, earnings growth in the first quarter for the S&P 500 companies were solid at around 13%, with nearly half of that increase coming from big tech companies known as the Magnificent Seven or the Mag Seven. Normally, investors would be celebrating these numbers, but they were produced before most of the tariffs went into effect, which clouds the outlook a little bit. Perhaps the biggest positive surprise last earnings season was 30% plus earnings growth for the Mag 7. Every one of them maintained their capital expenditures guidance for the year, or in Facebook Meta's case, they increased it. This CapEx expected to exceed $340 billion this year is a huge potential driver of earnings growth and future productivity gains. Earnings are going to need to carry most of the load if stocks are going to achieve attractive between now and the end of the year returns. The outlook for the economy and corporate profits remains clouded still by the tariff uncertainty, a potential uptick in inflation because of that, and the risk of higher long end yields. In that environment, LPL Research believes the opportunity for expansion of the S&P 500 price to earnings multiples, or the PE, is relatively limited. Recent valuations slightly below 22 times reflect a fair amount of optimism on trade policy, given below average earnings growth is likely this year and early next. We forecast 6 to 7% earning gains in 2025 and 2026 as price increases and corporate share buybacks help offset slower economic growth and tariff-related pressure on profit margins. Trade policy uncertainty and the potential for more tariff-driven upward pressure on inflation and interest rates make the case for a higher price-earnings ratio tough to make. But as long as tariff rates don't go higher, we believe the S&P could hold its current PE near about 22. LPL Research's year-end 2025 fair valuation target on the S&P is actually it's lower than it is today, based on current numbers, between 6,000 and 6,100. Key risks to monitor besides trade policy include stagflation and heightened global political risk. Now, there are paths to more upside. One is unanticipated productivity gains from AI investment. Another is the additional legislation and recently passed enacted legislation that could help lift corporate profits, as could just a general, more definitive pivot from the administration back towards a more pro-growth friendly policy ahead of midterm elections. Lower interest rates could also help. There's talk of potential interest rate cuts. A blue sky bull market case scenario would put the index potentially at about 6,500 at the end of the year, which it's already closing in on, based on a PE of 23 times earnings. So uncertain, a lot of uncertainty out there with the markets as always, and we'll talk more about that as we continue forward. The next issue we're going to talk about, or just talk forward on, is bonds. So the bond markets have also been very interesting and more volatile than we've seen in quite some time. So Susan, tell us a little bit about what's going on and what we are looking forward to in the bond markets.
Yeah, thanks, Mike. You know, with our current bond market, it's called the Jekyll and Hyde bond market because it's a tug of war right now between the economic data and the deficit spending. The Treasury yield curve has steepened recently, but it's still not steep by historical standards. Normally, the spread between the 2-year and the 10-year yields is close to 1%. Today, it's only about positive 0.48%. The Mr. Hyde side of the bond market is debt and deficit concerns, which we think the curve could steepen further this year, but right now the 10-year offers only 0.5% more yield than the 2-year while carrying 5 times the interest rate risk. And really, the bottom line in our view is this doesn't provide a strong case for extending duration in portfolios at this time. And with that being said, let's go to the next slide and talk about the Dr. Jekyll side of the bond market, the positive angle. Treasury yields largely follow expected Fed cut rates, and right now, markets are pricing in less than 2 full rate cuts this year, with a trough Fed funds rate around 3.7%. and this is well above the Fed's neutral rate of 2.5%. If growth slows and inflation eases, markets could price in more cuts, creating room for the treasury prices to rise and yields to fall. Debt deficits and supply demand issue remain headwinds, but without a major shock, we don't expect to see 5% on a 10-year again soon. And if we do, that could be a good time to add duration. Should the economy, especially the labor market, slow more than expected, or if geopolitical events prompt the Fed to accelerate rate cuts beyond what is priced in, Treasury yields will likely decline more significantly from current levels. And now Mike's going to jump to the next topic of commodities.
And yet another interesting category of our economy, mixed results amid messy macros. Commodity markets, which are basically places where raw materials or primary agricultural products are bought and sold, think gold, corn, oil, coffee. They've also faced a turbulent first half of the year. Tailwinds from a weaker dollar were largely counterbalanced by a downgraded global growth forecasts, higher for longer monetary policies, tariffs, and an underwhelming economic response to China's economy throwing some stimulus for the Chinese government throwing stimulus at their economy, which China is the world's largest importer of commodities. This backdrop left the Bloomberg Commodity Index with a 1.2% gain through May. Technically, hope for the start of any major commodity super cycle, which is a period marked by a highly synchronized rally in commodity markets, was put on hold as the index struggled with resistance from its prior high, as you can see in the chart. While downside risk to the dollar, the prospect of a sustained economic rebound in China, the green energy transition, and a huge booming data center demand all remain valid catalysts for a prolonged commodity market rally. The first steps to kickstarting the super cycle will be for this index to break out of its range with a multi-week close over about 109 or 110. So gold, that's a question that we started getting as the markets got volatile. Gold continues to capture the spotlight as the precious metal rallied over 20% through May. The advances briefly pushed prices to $3,500 before profit-taking pressures emerged from those overbought levels. Gold's valuation relative to the S&P 500 also recently reached its highest level since the onset of the pandemic, suggesting there's a risk for mean revision from these lofty levels, which basically means a risk for gold coming back down to its average prices. A weaker dollar and inflows into gold-related exchange-traded funds helped offset a recent uptick in real yields. Rising geopolitical tensions, again, elevated equity market volatility, and historically high levels of trade policy uncertainty further underpinned the short-term case for gold. There's also been really steady demand from global central banks, which has also been another catalyst for gold as they continue to diversify reserve holdings away from the dollar. According to the World Gold Council, global central banks added to their reserves of gold in 2024, marking the third straight year of this type of increase. The trend of more gold and fewer dollars in foreign reserves could be sustainable. Over the last several years, central bankers have expressed an increased intent to add to their gold reserves, according to the World Gold Council. In 2024, 81% of central bankers indicated they would increase their gold reserves over the next 12 months, which, as we know, more buyers than sellers means that prices would trend up slightly in that potential market. So that said, talking about the impact of commodities, what would be the impact on currencies?
Yeah, now
Dollar.
now touch on the dollar as our last topic, and Mike mentioned earlier the weaker dollar, and yes, the dollar has had a rough year. The U.S. dollar index, the DXY, is down 8.4% through May, its second worst start since 1973. Selling began in January as post-election momentum faded and competition from new cost-effective AI models like the rise of China's DeepSeek and other low-cost AI models, which threatened U.S. tech and reignited debate over American exceptionalism. And this is a key driver of U.S. capital inflows for over a decade. We've also seen a rotation out of U.S. assets as global markets outperform, prompting investors to increase currency hedging and sell U.S. holdings. While we don't believe the dollar is losing its reserve currency status, persistent headwinds have pushed DXY, the dollar index, to the lower end of its multi-year range. And yeah, and that's what we're expecting right now, and we're not exactly sure where it's going to be headed here in the future.
So we covered a lot of ground. We covered a whole lot of ground in a relatively short period of time, and there's a lot of numbers. So as we bring today's outlook to a close, we want to thank you for tuning in. We know you could have spent this time doing literally anything else, like watching the market ticker with one eye twitching, but we're glad you chose to spend this time with us today. The markets, as always, will do what it does. It climbs, it dips, it bounces, and confuses the headlines. But through it all, staying patient and disciplined remains the most powerful investment strategy, along with not checking your account balances every 5 minutes. If you're wondering how the latest economic twists or financial news might impact your investments, please don't hesitate to reach out. Whether it's a quick check-in, a full review, or a second opinion, we're always happy to talk shop with our clients. And we genuinely appreciate you. We can see who's tuned in, and it's just awesome that you take the time. And we're honored to work with you. Your success is personal to us, and we're here to support you through all of the market seasons, bear, bull, and everything in between. And of course, if you know somebody that could use a financial team that balances data with a dash of fun, send them our way. We promise to keep the spreadsheets neat and the market metaphors under control. So on behalf of the team at M2 Financial, thanks again for joining us. Be well, stay cautious, and we look forward to our next conversations. We're going to end with some important legal disclosure, so stay on as long as you'd like. We'll kind of get through those. And again, thank you all for participating with us today, and we look forward to our next conversations.
Yes, thank you.
Bye.